Special Purpose Acquisition Company, or commonly known as SPACs, have become one of the hottest investment vehicles in 2020 with over $54 billion raised in IPO till date. In my recent webinar with retail investors, I spent some time in demystifying SPACs. I hope you will enjoy this discussion. Okay, so today we're gonna dig deeper into SPAC, Special Purpose Acquisition Companies, or corporations. Before we start, I think a quick disclaimer, this is not a financial, investment, tax, or any type of advice. We are all here to learn from each other. So don't trade based on what you hear in this session. Use your own discretion. Talk to any consultant that you may have. All right, so a quick background on why we are talking about SPACs today. So first, let's understand how companies arrive on public market, right? Where one process that we all are very familiar with is traditional IPO process, like Snowflake, fresh on our minds. In this traditional IPO process, the company's management, they work with underwriters. They find underwriters, Goldman Sachs, JP Morgan, those investment bankers who are paid big bucks to understand company and then to underwrite that company. And then they also have to find investors, try to figure out what's the investor appetite for their company. The company executives, they will go with their underwriters, they will go on the roadshow, meet a lot of institutional investors for a week, for 10 days, trying to tell them what this company is about and what it could be worth. And then those investment bankers, they will try to figure out what's the interest among those institutional investors about the company, at what price point they may be willing to buy. So through all those discussions and negotiations, underwriters arrive at a price point. So with the Snowflake, it started at $70, $80, $90. And then when Warren Buffett jumped in, Salesforce jumped in, underwriters figured out, there is a lot more interest than what we had earlier thought. Let's increase our price. Eventually, they increased it to $120, right? And in this IPO process, it's the underwriters, it's the bankers, they buy the shares from the company. Then they work and take it through the listing process with the exchanges. Okay. So when Snowflake had IPO'd at 120, means the company actually got $120, but when it opened in the market, it opened at $240. People say, oh, it's a great IPO because it jumped 100%. It was IPO'd at 120. It opened at 240. It's a fantastic IPO. I have a different opinion. I think it was a failure of an IPO from company perspective. It was a great IPO for underwriters because they got the shares at 120. A company missed out on the lot of money that they could have raised. Snowflake as a company only got $120. So they could have gotten double the amount of money if underwriters would have been able to figure out what the actual demand could be once it is listed. So from my perspective, I look at most of the money should have gone to Snowflake. So they would have been able to invest in their business and grow the business like hell. Instead, big chunk of money went to the bankers. So when you say it's a success, it's a great IPO, just think from which perspective are we talking through. From a perspective of bankers, it's a great IPO. From a perspective of initial investors who were now able to sell in the market, great IPO. From perspective of Snowflake as a company, not that great. And I'm sure, the CFO of Snowflake would have been talking to whoever was the underwriter company. What the heck? We left so much money on the table. Anyway, so that's one process, and that's one big flaw which a lot of companies are saying is this process is broken. We as a company are leaving a lot of money on the table. And instead, these bankers, the intermediaries, they are becoming richer. All that money, Snowflake company should have gotten $240 per share that they sold. Instead, bankers bought the share at 120, and then whereas the market is ready to pay $240 for the shares. So this is a negative sentiment I'd see around the traditional IPO, making the rounds, the process is broken. So the second option is direct listing. Spotify, Slack. Spotify for the first one, then Slack, and this year, a couple of other companies, Asana, Palantir, they all went through the direct listing, means you don't have those underwriters to find out or to buy the shares from you. They don't do the roadshows. Instead, it's an investor day where they'll tell what the company is about. And those shares get directly listed on exchange. So there is no underwriter or no bank to back up those shares. And don't get me wrong, underwriters, they do play a role in this market. The role of underwriters is to make sure the shares don't become too volatile, say if the shares is falling down, right? So generally, when you go through traditional IPO, say Snowflake got listed at IPO'd at 120. What if instead of it being a cloud computing, it was a cruise company, right? No one wants to buy a cruise company. People would short it, right? They will bring down the price of Snowflake, the cruise company. In those cases, underwriters play a role that they can buy additional shares from market. They have an option to buy additional shares at the IPO price. So they'll try to stabilize and make sure that the price don't, fall down too much. So if you're going direct listing, there is no underwriter. It's out there in public market. The market will determine what the right price would be. But there has to be some opening price. So exchange find out based at what price point they would open, and they look at the last few months or few days of the valuation of your company, and based on that they define using a set formula saying this is when we will open it up for on the IPO. In these cases, many of the cases company just don't raise any money. It is just that they want to list their shares on the market for some employees or early investors to have a liquidity event. One other thing is on traditional IPO process, there is a lock-in period of 180 days. On direct listing, there is no lock-in period for employees. There is no lockup period. So the traditional 180 days of lockup period does not apply to direct listing process. So these are the two main processes that we were familiar with on how companies come onto IPO. The third one is, okay, forget about both. Let's move on to the dark side. And that is what is SPAC. In 2020, we saw renewed interest, and SPAC is not anything new, just that there was not much happening on the SPAC. But in 2020, we saw a spectacular increase in IPOs of SPAC. So till now, 54 billion have been raised in SPAC IPOs. It's already 4 times the amount raised in 2019. And the stats are till end of September. So we still got one more quarter to go. This is the total amount of money that have been raised on SPACs. In 2020, it's already 54 billion. Like I said, this is nothing new. SPACs have been there for quite some time. If you look at this last decade of stats, 2009, one SPAC IPO. 2019, 59. 2020, by end of September, it's already 139. Too much interest in SPAC. And that's the reason, even we are talking about SPAC. So what is SPAC? It is an acronym for Special Purpose Acquisition Company. It's a shell company. It doesn't have any products. It has no services to sell, no products to sell, no plants, no machinery, no land, nothing. It's a paper company. It's a shell company that has been created just for one purpose. And the purpose is to raise money to acquire another company. That's the sole purpose of any SPAC. So they do an IPO to raise money, and then they have that money, and the purpose is I will go and acquire other company. So type of SPACs, there are general purpose SPAC in which when the SPAC goes IPO, and again, the SPAC has to go through that, traditional S1 filing, etc. So if you're interested in to know what the SPAC would be investing in, go and read that S1. They will specify in their S1 that have they already, is it a general purpose? Means I don't know what I may want to acquire. Whatever opportunity we think in whichever sector, we will look into that. Or it could be a specific type. We would acquire or look for acquisition in gaming industry. That's a specific SPAC. We will look for investment in travel industry. Again, specific SPAC, right? So they may not specify which company because they don't know what opportunity they may find, but they want to be focused on a particular industry. So these are generally, the type of SPAC that you may see. One is general purpose, the other one are very specific ones. Okay. Typically, SPAC has got close to 2 years from the time they raise money to find a company to acquire. Because that acquisition time is when it's a liquidity event for the investors in SPAC. So they do the IPO, SPAC, and SPAC IPO is easy because there are no, previous financial reports. There are no products to talk about. There is no specific competitors to talk about. There is no, operations to discuss. It's only thing, that is why the IPO for SPAC, it take around 2 months. A company going an IPO is a year-long process, or sometimes more. A SPAC going IPO in 2 months, if I'm a well-known expert in a particular industry, and then, we see that there's a lot of craze about SPAC, and I know that people would have faith in me and would invest if they know that I'm in the market to raise money. Good time for me to create a SPAC. And I was just listening to a funny news is, again, some of those executives, those who had built companies, sold companies, and were now doing and enjoying life, by buying baseball teams or being owner of basketball teams. And I was reading about one such executive is, he was saying many of his friends came and told him, why don't you, form a SPAC? And then that guy was like, what the heck is it? What is this SPAC? And then he did some quick reading for a week. Like, okay, I can do it. And within a week, there was a SPAC. He created a SPAC and he raised some money. So creation of a SPAC is easy. It takes, going through IPO around 8 weeks. And then comes I would say the tough part is you have to identify which company you want to acquire. And then which takes maybe around 19 months, close 18, 19 months. And then you close the whole acquisition. So generally this is like almost 2.5 year long process. So if you are investing in SPAC, consider it as your CD for next 2 years. It's a 2-year duration CD, though you can't break it. Okay. Now, there was a question, when are you creating SPAC, Vivek? All right. Yeah, sometime. Those times will come, not now. But I think by that time, SPAC will not be in fashion anymore. It's like a fashion. I mean, it was there today. It is in fashion. Who knows where SPAC will go? So from a company, like I said, the whole purpose of SPAC is to acquire another company. So that brings up a question. Why would the other company would go through SPAC and not go through either the traditional IPO to raise money or through the direct listing? Why would they agree to be acquired by a SPAC? One reason is IPO process is cumbersome. I've been in a company where we had an IPO and we have seen it. It takes minimum from, within a company. Because now what we see is when a company have filed confidentially for S1 and then, but the prep actually starts long back, much prior to that. And it takes more than a year for a company to start preparing for IPO. It's a cumbersome process. Your execs, a lot of the attention, time of the executive is spent in preparing the company for IPO. Suddenly you will see the whole C-suite rooms are vacant because all of them are on roadshow. They're gone for a week. They're gone for 10 days. They're all on roadshow. CFOs, CEOs are meeting, every week they're meeting investors and then trying to explain about the company, et cetera, et cetera. It takes time. So, and it is expensive. Now, in last 2 months, ever since I started reading about these SPACs, or probably 3 months, I've changed my viewpoint on this expensive. So earlier I thought that going through the SPAC route is cheaper for a company to get money that they need for growth. I don't think so anymore. All that is why I put it in quotes is it actually could also, it could be more expensive. And we will talk about it, how it could be. It depends on how the SPAC terms are. So it is not always cheap. The upfront cost may be, but there are inherent costs that it might make it more expensive to raise money through SPAC route than through traditional IPO route. But it's much quicker. It is much easier, right? So if you go to traditional IPO, like we talked about, you have to convince a lot of institutional investors, right? And not just one, 10, 15, 20, 50. All the investors that you meet from morning till evening for whole full 1 week on a road show is like, it's not an easy task. It's like, the management is trying to sell the company. It's like a hardcore sales job that you have to knock on every door of institutional investors and sell your company to them. Convince them to invest in your company. The price that you're looking for keeps on changing, right? We talked about Snowflake. it was it was good that their price was increasing. We have also seen other companies where the price kept decreasing. I think I forgot, probably Palantir, or some other company where they had to reduce the price because the investors were not willing to pay the price that the company was looking for or the underwriters were hoping for. Other is why some companies go through the SPAC is you get more cash upfront. And you have a little certainty about how much amount of money you're going to be able to raise. In SPAC, you have to convince only one investor. If I'm a company, I'm a small company, and I need money for growth. Traditional IPO, I have to convince 50 investors, work with bankers to convince them. In SPAC, I need to convince only the SPAC management that I'm talking to. And we get a lot of money. It's not just a SPAC money. There's another concept, PIPE, we'll talk about it, which is additional money I can raise. Second is, and this is again, I think most of the SPACs are like this. These are the specific purpose SPAC. What I talked about is the incentives of the SPAC sponsors and the companies are aligned because many of the SPAC sponsors, they get paid as an equity stake in the company. Number two, most of the SPAC sponsors are actually seasoned executives in those industry. In a traditional IPO, I have to convince the investors as Fidelity institutional investors, at Vanguard, at BlackRock, at some hedge fund, who have no idea about what my company does, who have no idea about what we do at Optiongig. So I have to convince them, I have to tell them what my business is, I have to explain it to them, what we do. And but in case of a SPAC, probably I'll reach out to a SPAC whose sponsor has been an ex option guy or has been an ex investor education guy, because then it's much easier for me to explain it to them. And not only I'll get money as an acquired company, I also get its expertise. We benefit from the network that, it's like a venture capital help you get from those expertise in a public market. But one thing you have to be sure of, the sponsors of SPAC becomes your bedtime partners. In many cases, they actually become the chairman of the company. So make sure as a company executive from acquired company, if I want to raise money through SPAC, I am okay to live with a SPAC sponsor. A quick look from an investor perspective. If I'm investing in SPAC, it's like a share with put option for free. And we look at the reason. Reason is most of the SPACs, they come out at $10 price. And those will be redeemable at $10 at the end of 2 years if SPAC is not able to find any good company that they want to acquire. So generally the period mentioned in S1 is 2 years. It could be extended, but generally it is 2 years. So if I invest in SPAC, so I'm a SPAC investor, I'm investing in SPAC. My perspective is, why would I want to invest? I invest $10 in 2 years. If I don't like, or if the company doesn't find, the SPAC doesn't find a company to acquire, I can redeem back those shares at $10. Right? So I got a put option and for free means I don't have to, I have a guarantee that I'll get back my $10. Or even if a company, if the SPAC is able to acquire a company and I don't like what the company that they're acquiring, I can redeem my SPAC shares. So, I have an option saying I invest in $10, I can get back my $10. But if you like the company that is being acquired, then I get into it earlier than anyone else. So that's a perspective of investor. Now, mind you, that the redemption of a SPAC shares happens at the par value. So most of the SPAC shares, when they raise money, they raise it at $10. There are exceptions, but most of them have a base price of $10 and it will be redeemed at $10. So if you are buying a SPAC shares from market and the SPAC is now trading at $14, don't think that you will get, your shares will be redeemed at $14. That won't happen. The redemption value is still $10. Okay. So let's look at some of the SPACs that have been in news. In the recent times, this was a IPO Social Capital. Sponsor is Social Capital. SPAC is Heather Sophia Holdings. Number one, IPO they raised $600 million and they merged with, or they acquired Virgin Galactic. Now the process happens is, if a SPAC finds a company and they acquire the company, then the ticker of the acquired company starts to list on the markets. So if you look into SPCE, for 2017, this ticker was IPOA. And it traded around what, $9.96, around $10, right? It traded at, it's listed when the money was raised. And then it fell down. And I think maybe around here is when it would have acquired Virgin Galactic. And then the IPOA ticker changed to SPCE. And then, it becomes Virgin Galactic. Same is the case with NKLA, Nikola Motors. This year, why the SPAC became hot is because of Nikola. At least I got to get into SPAC. I started looking at SPAC because of Nikola, because I saw suddenly there's a company called Nikola Motors and it is rising. How come I never heard about this ticker before? Why this was not on my radar? And then I realized that it didn't exist before March. Before March, it was trading under its SPAC name. The merger happened somewhere over here. And then when this merger happens, the SPAC basically takes over the ticker for the company. So then it starts to trade under ticker NKLA. This is how the workings of the SPAC is. Again, the other acquisition was Diamond Eagle acquisition. That's another SPAC. They raised $400 million. They took DraftKings to IPO. They brought DraftKings into public markets. Vecto IQ, we just talked about it. It was Vecto IQ, and then they acquired Nikola Motors, and suddenly Nikola Motors is on radar for all the investors. Now the more recent ones, Heather Sophia Holdings 2, IPO B, $360 million. They have agreed to acquire Opendoor. The acquisition has not been completed yet. So right now it is still trading as IPO B. But see, it was around $10 or whatever, $11. They announced that they're going to acquire Opendoor. They're working through that merger process. Remember, we saw that even after announcement, it could be another 2 weeks before they finish the merger process. And when this acquisition process is completed, when this activity is consummated, IPOB will become, I don't know, what's the ticker of Opendoor, whatever, OPDR or whatever the ticker is. So right now it is IPOB. Sophia Holdings 3, IPOC, 720 million. Clover Health, they've already found out the company that they want to merge with. They want to bring it to public. It's called Clover Health. So IPOC, again, right now it is, I think this acquisition has not been completed yet. Yes, so that's why you still see IPOC trading. Whenever that acquisition is completed, it will become Clover Health. Okay, so these are some of the recent ones that have gone in. And the sponsor behind all these IPO A, B, C is Social Capital, run by Chamath Palihapitiya. He was an ex-VP of growth at Facebook, made his money on Facebook, and now he's a tech investor, a big-time investor in Silicon Valley. So he has got some good record to show in terms of SPAC. And his target is to make this from A to Z. So I think they already have IPO D, IPO E, IPO F. And one of them is more than $1 billion. So there are already 3 SPACs that Chamath has raised. Maybe we can look into it. But they are waiting for some good opportunity to find a company that they want to take public. Social Capital. Let's look at. Oh, their file is full. I think even they have this is little old. This is a month later. I think they have till F or something like that. Oh, no, this is 5th. The 5th was done in October 9. No, there is one more after that. So Chamath has been very active in this space. Any of you have invested in any of the SPACs earlier? Anything to share on your own experience with SPACs? Looks like no. All right, so when SPAC, goes IPO, what's listed on the exchange? And this is very interesting, and it is important for us as investors to understand. Otherwise, we will get the surprise which most of the retail investors got during Nicola. So what they list are units. Units has got a share and some warrants. And those warrants could be 1/9 of a warrant, or 1/4 of a warrant, or 1/3 of a warrant. You have to read the prospectus S1 to find out what that warrant is. So let's take a quick look at things that have not been consummated yet. IPOC. Okay, so IPOC, we already have F. So IPO F. So in IPO F, you see this is IPO F by itself. Come on, load it. It refuses to load it. So let's try something else. Okay, this is another one, a SPAC. In this case, you can see it has got PSTH. It has got units, which is PSTH/U. It has got PSTH, PSTH/WS. So when a SPAC gets listed on exchange, it's got a units, which has got PSTH/U. It has got 1 share of PSTH and a portion of a warrant. Share has got 1 share. PSTH has got 1 PSTH share underneath it. warrants, PSTH/WS. Those are the warrants. No surprise there. Those warrants can be converted to stock at a predefined price. So generally, this is like a call option. So generally, most of the SPAC IPOs will have that the warrant can be converted into stock at once the stock price is, at the strike price of 11.5, because SPAC IPO is at base price is at $10. That warrant can be converted at a strike price of $11.50 at a particular time. So they have some conditions. So make sure you go through before you invest in any of these, either units, shares, or warrants. You understand how does these warrants work? When would you be able to, convert your warrants into the shares? There is a price. There is also a limit on what time before which you cannot. So go through that. So, but if the shares don't hit that 50% highest price, that warrant could go to zero. So this is like a call option. So if you just want to buy, instead of buying PSTH, you want to buy warrant, make sure you understand, when would you be able to redeem this warrant? What's the base price of stock need to be, for the redemption? And if the share doesn't hit that price, or this become worthless. This is like a call option. So I think when the SPAC comes IPO, it's a unit, and then probably they split into share and warrant separately. Oh, we already took this example. PSTHU has got 1 share and 1/9 of a warrant. So it means if I were to invest in PSTH/U, I would want to pick it up in the multiples of 9, so that, let's say, the warrant exercise date may be 30 days after the merger is completed, and I want to exercise my warrant, want to convert my warrant into shares. I know that the 1 is equal to 1/9 of a share. So I need to have the multiples of 9. Otherwise, I will get the rest in cash. So understand that, in terms of what's the warrant, the fraction of a shares of the fraction of the warrant that is available in the unit. Okay. At some point of a time, unit will split into shares and warrants, and then you will see these two also started to list. Each whole redeemable warrant entitles holder. Oh, we talked about it. Okay. So in case of Pershing Square, it is not $11.50. It is $23, because the Pershing Square actually started at $20. It's not $10. So the general criteria is 15% higher than the base price. So if it is $10 is the base price, then it will be $11.50 is the price at which the warrant will entitle the holder to convert it for a share. So if I'm holding 1 unit and the PSTH is above, at 23, and the time has already arrived where I can convert, I'll have 1 share and 1/9 of a share. And if I want to convert the warrant, I will get 1/9 of a share, which I can't. So I'll just get the cash. But if I want shares, I want to make sure I buy it in multiples of 9. Oh, see, Ramesh saying, can you please show us S1 of any SPAC? Okay, let's bring it up. PTH S1 document. Go to Edgar. There we go. All right, so it mentions each unit consisting of 1 share and 1/9 of a redeemable warrant. Now, most of them, SPACs will have the offering price as $10. Pershing Square is from Bill Ackman. He wants to do things differently. He plays big, right? He's a big hedge fund guy. So he offered the price at $20 instead of $10, right? And there will be some warrant conditions mentioned. Okay, let's read through here. So it says this is an initial public offering for our securities. Each unit is $20 and 1/9 of one redeemable warrant. Okay. And then that says that we expect that the units will separate on 52nd day following the date of this prospectus. So coming back here. When PSTH went IPO, it was only PSTH/U. 52nd day, after, on 53rd day, it's split and you have PSTH and PSTH warrants. So let's look at here. So we have PSTH warrants. Let's look at what happened to PSTHU. It didn't trade after whatever, September 10th, because it split into shares and warrants. So this was when it was initially listed at around $20, went up all the way. 52nd day, after 50, on 53rd day, it's split into shares and warrants, and then the unit stopped trading. Okay, each redeemable warrant will entitle the holder to purchase one share. Oh, this might be an eye chart for you. Okay, this could be better. So let's look at this as, so there he talks about warrants, which entitles the holder to purchase one share at a price of 23 per share. So this is like a call option with a strike price of 23. Now the redeemable warrant will become exercisable, and this is a condition on when you can exercise your warrants. On the later of 30 days after the completion of initial business combination, or 12 months from the closing of this offer. So you have, once the SPAC decide to buy a business, 30 days after that, or 12 months from the closing of this offering, whichever is later. And you have this call option, long-term call option for 5 years. So these are the things you need to be aware of when you're going through it, is when will that warrant expire and how long it is available for, when do we have to make a decision, etc. Oh, it was right over there. Okay, that's what I picked up from S1. So anyway, we saw this in S1 already. So now let's come to how we build our investing thesis of investing in SPACs. So the question, so why should we or why should not we? So before investing, make sure you trust the sponsor and the management of SPAC. There is nothing else in it. There are no products. There are no services. There are no books. There are no financial statements. There are no revenue numbers. There are no research reports. Only thing in SPAC is it Bill Ackman or is it Vivek Somani? So you trust whom you want to trust and put your money behind that person. That's the only investing thesis. Nothing much on SPAC. What's their track record? Are they doing it for the first time? Have they done and taken and identified some companies and have brought them to public, and then those companies have done really good? Chamath, he got some track record with Virgin Galactic. No wonder he's been raising money. I started with IPO A, now he's got what? IPO F. So how much personal money have they put in? Has Chamath committed money from social capital into these IPOs? I don't know. I haven't studied. I know that for Persian Capital, the SPAC is of $3 billion. And then Bill Ackman has already committed that he will bring in additional $1 million from his Pershing Square hedge fund. So he is putting his hedge fund money behind it. This is, when we generally review the stocks, this is the section where I bring in skin in the game. Does the management have skin in the game? Or is it all outsiders' money that they want to play with? So when you're looking into a SPAC, might want to see it. Or this one caught my attention because of just one SPAC that I came across it. Is it just financial engineering or is it a real business acquisition? So as always, whenever any trend becomes really hot, any new trend that that catches investors or fancy, you will see a lot of players who are trying to take advantage of that model. So I came across one SPAC in which the owner of the SPAC and the company that the SPAC is acquiring is the same. Is a one person who owns the SPAC, is a sponsor of a SPAC, and the same person owns the company that the SPAC is trying to acquire. I'm like, what the hell? I would rather stay away from that. This is no real business acquisition. You already own that company. Are you trying to do, then I won't have any faith in terms of what's the due diligence the SPAC has done on that acquiring company. Right? So stay away. I would not say stay away. I would say, make sure you check those SPACs really well. Other thing to look at, how many units are allocated in founder's pot? So founders means the sponsors of SPAC. So when the SPAC brings a company onto IPO, generally they get 20% of the company. That's a general criteria I'm seeing in almost all the SPACs. So that's, as a founder, they get a nice kitty. So look, if in some of the SPACs it is less, it means they're leaving a lot of money for the investors, and not founders are cornering the initial bounty. So look at some of these things before you invest in SPAC. How many warrants are included? We talked about is 1/3, 1/9, 1/4. When do the warrants expire or redeemable by company? In some SPAC, I even saw that company could call the warrants back. You would forcefully maybe ask to redeem the warrants. So you got to read through it. How many warrants are issued to PIPE investors? And this is what caught Nicola, investors like you and I by surprise. I didn't know about these PIPE investors at all. And somewhere, Nikola Motors suddenly fell down and everyone was, what the heck has happened to Nikola? Right. And the reason was, there were a lot of PIPE investors, which is called private investment in public entities. So let's talk about where this PIPE comes into picture. So we talked about that the SPAC have raised money, $600 million. Now, the open door, or let's not even talk about open door because I don't know what the real numbers on open door is. Okay, say a SPAC have $500 million and I have a company, OG Biopharma. We talk about that company. Great company, everyone should invest in. Okay, I'm kidding. So the SPAC reaches out to me and say, hey, we want to buy your OG Pharma. I'm like, it's 10 billion worth. SPAC says, okay, we want to buy, 20% of your company. Fine. That means $2 billion. SPAC has got only $500 million. That's where the founders or the sponsors of SPAC will reach out to their friends and families, other institutional investors, hedge funds, to raise $1.5 billion. Those are called PIPE investors. Those are private investors who are now investing into the SPAC, which is already a public company. SPAC has already been IPO. And those PIPE investors, they get warrants. And that's what happened in Nikola. Vector IQ had only $200 million. And at whatever money that they had to spend on Nikola, they raised it through the PIPE investors. Those PIPE investors got warrant. There are conditions on when those warrants are redeemable. When the date came along, all those PIPE investors, they converted their warrant into shares. Boom, market is flooded with Nikola shares. Share price fell down 26%, or I think it was maybe 26, 40%. So if we had known on Nikola and Vector IQ, we would have figured out that the warrants are about to be redeemed, get out, or be aware that you're gonna go through this ride. So, and most of the SPACs will have PIPE investors. So do your homework. This is not, this is a high risk, high reward game. So any questions? I need to sip some water. Now we will review some of the SPACs and we'll open for Q&A. I see Sachin says in Vivek we trust. Oh, thank you. Now it gives him more confidence to open up a SPAC. I have one investor at least. Ramesh says, I rather trade options and buy the stocks of reputable company stock. That's always been a choice. This is a new investment vehicle. And so we want to dig deeper. Only thing I want to make, educate is don't invest blindly. This has become another hot commodity in 2020, as we have seen, the number shows. So be aware of what the gotchas could be, what are the things that you need to look into before you invest. And you might find something which could be, quickly become, let's say, 5-bagger, 6-bagger, right? We cannot get into the pre-IPO price as a retail investor. We can't. So by the time company comes to IPO, what happened in Snowflake? It's already double. But by investing in SPAC, and if you've done our homework, we are getting into a company kind of a pre-IPO. So let's look at some of the SPACs that I spent some time and see if any one of these fancy you. Some of the SPACs pre-merger means they haven't yet identified any companies. And then we will look at some of the SPACs, those who have already identified the companies that they want to merge with, but the merger has not happened yet. ECNP, Executive Network Partnering Corporation. As the name suggests, it is all about networking. $300 million they raised in IPO. Sponsor is Paul Ryan, former House Speaker and former Vice President candidate. This is a SPAC which is a powerhouse. It's a politically connected SPAC. Financial sponsor behind is SPAC is Mitt Romney's son. So any company contracting or selling to government, this SPAC would be useful. So if you, now Palantir is already public, so we can't look at that. But if you have any, if you're interested in the companies that work mostly on government contracts, still is a private company, and you think that they may be looking for an IPO, maybe you want to follow ENPC and see if they are the one, there's a match. Or if your experience shows that some of those companies have grown, then over once they become IPO, maybe then get in ENPC. They will probably find some company, and with the type of backers, they may have some better success in working with government contracts. Pershing Square. This is the one which probably again, educational opinion only, but I might get into it. This is a $4 billion with additional commitment up to $3 billion from Bill Ackman. Bill Ackman has some experience in SPAC. So long back, he used a SPAC to effect the merger of Burger King and restaurant brand. Bill Ackman is also a well-known investor, hedge fund manager. He has had his own glory days and gloomy days. Herbalife, didn't work out. Chipotle, great success story. So if you have faith on Bill Ackman, you think he can pull off a merger with some really big company, you may want to look at PSTH. So what Bill mentioned, he's looking for a mature unicorn. Don't want to invest in companies like Nikola who have no products. And he wants to take a minority stake, 20% or 30%. Unicorn, which is mature. Could it be Robinhood, Airbnb, Stripe, Chime, Coinbase, SpaceX? All these are on, I'm sure all these are on Bill Ackman's radar. What I also read about is that Airbnb, he probably approached Airbnb and Stripe, and both of them have told, no, we don't want to go through a merger route with SPAC to raise money. Maybe those Airbnb wants to go through traditional IPO route. So check. If you have faith on Bill Ackman and you think he will be able to bring any of these or some other mature unicorn onto public market. And remember a few sessions earlier, someone asked, how do we get into a company pre-IPO? This is one another route. Maybe buy PSTH and then let Bill Ackman do his homework. Because his SPAC is so big, he needs to look at a company that is a $20 to $40 billion valuation. He's not after the smaller companies. Secondly, and this is what I like the provision, which probably tilt PSTH more favorably towards me, is the Tontine provision. I mean, he picked up the name because of this provision. It means if I want to redeem my warrants earlier, etc. So I've not known the exact data, but the way it is, this whole provision makes it attractive for the warrant holders who hold their warrant for a long time. So for example, when the merger is happening and I don't like the company, I want to redeem my shares, I can redeem my PSTH shares at $20, but then the warrants, the PSTH share and warrants, the warrants in that will get distributed to the ones who have not redeemed it. Something like that. So if you're holding PSTH for longer, if some of the investors go out, you are benefited. So what Bill Ackman is doing to make it more attractive is providing more incentive for long-term holders. And he is also not taking the 20% cut that generally we have seen in the SPAC sponsors are getting it. So Bill's point is, if I can get 20 to 30% off a mature unicorn, and my hedge fund is already invested in it, I think that's all I want. So he's not taking it to 20%, the initial founder one, so that he can bring in more and more, make this PSTH more attractive for investors. Okay. But again, these are all pre-merger. We don't know what he's going to buy. It could buy Robinhood or it could buy OG Pharma. That all depends on what Bill wants to do. Go Acquisition Corp is the next SPAC. Objective is to acquire a company in a travel or related businesses. So currently this is in a distressed sector. So they may not be able to find it. Or so they may be able to find a good deal, because who's gonna raise money in IPO? If I'm building a software for an airline company, maybe I'm building a next generation kayak, who's gonna invest in me? No one. It's a distressed sector. So this SPAC may be able to find out some companies at much lower valuation and bring them to IPO, right? Again, so this actually trades at less than the initial IPO value. So let's look at, oops, wrong in animation. So they raised $575 million at a price of 10. The founders have been involved in SPAC. And the other founder, he's a seasoned executive in travel industry. Now, the interesting thing when I looked at GoAc is it's trading at less than $10. That means either market thinks that these people can do the merger. Oops. It went up on 16th. Oh, so when I put this deck, I put this deck on 14th. It was actually at $9.75. And I took some positions. Oh, but sorry, on Friday, I didn't notice that it actually went up to $12.65. Okay, so imagine, forget about Friday. Okay, my thesis of why I picked up some position and I put it up in 401k is I wanted to invest in non-risky asset. And I was looking at it. I got it at 975. And I was like, if nothing happens, I can redeem it at $10. It's 2.5%. It's better than Treasury. For me to hold on to this for whatever 18 months is left, for them to find out the new acquisition company. So I thought about it. I'm like, I'm not too, gung-ho about this travel sector, but 2.5%, I can redeem it at $10. If I don't like the company, today I can buy it at 975. I am looking to, put some money in a safe assets. Market is already too high. So I'm like, okay, I'm buying it. So I bought it at 975 and I wanted to talk about it today. I didn't know it actually went up to 1265. So anyway, that was my thesis. Okay, my thesis was to, instead of putting it in a CD, I'd rather put it in this one, because if nothing else, I'll get back $10 by investing $9.75. That thesis no longer hold today. Sorry, guys. But there could be other ones. I don't know. I mean, I came across this and then I studied this, who are the people, and then I saw that it is trading less. I thought, okay, we'll talk about it today. Now let's talk about post-merger. IPO-B. They raised $360 million at $10. We know about Chamath, already talked a lot about him. So they did a deal with Open Door at $4.8 billion. It's a pure play iBuying company, right? You buy homes on app. So Zillow, Redfin do have these options, but they are not pure play. So if you want to get into Open Door, you may want to consider IPO-B. After the announcement, IPO-B has already has run up high. So, yeah, but the merger has not yet been completed. It's been announced. So if you are interested in Open Door, you may want to look into this one. IPO-C is Clover Health, $720 million at $10 each. Same guy, they're merging with Clover Health. Now, in this case, the total money, so the SPAC raised almost $720 million. They have to spend $1.2 billion, so they're getting $400 million from PIPE investors. Third one, and this again, I might be interested in this one. I have to dig deeper into some of the founders. I mean, they have experience. So they raised Flying FEAC. They raised $600 million. Founders are Harry Sloan, Jeff's team. They call themselves Eagles team. It is their sixth SPAC. It's the same team that got DraftKings onto public. So they have some experience in this industry, number one, and in the SPAC, number two. They brought DraftKings, which is, again, we all know, online gaming, and it has caught fancy of investors. Harry is also founder, investors on the board of directors of ZeniMax, owner of Game Studio. So what they did, they announced that they want to acquire Skills, which is a mobile gaming platform. Now, from a founder perspective, they got a SPAC experience. They have brought in earlier companies SPACs. They're not only SPAC, they also have experience in the gaming sector. Gaming platform is going to be next hot sector. So I am building my own gaming basket. I might want to look into this one. So this one again caught my fancy. Is I'm putting this in my watch list. I'll do a little more study on this to see, if I want to take a positions on this one. So PS, so from my perspective, okay, we got one more. So then we will summarize. Next one, I think someone in our Slack group had talked about it earlier. That time I had no idea about what this KCAC is. Kensington Capital Acquisition Corp. Now they have announced that they want to merge with QuantumScape. Raised $230 million. Founder is Justin Miro. Now this management team has been very active in automotive sector. They've done 70 automotive transactions, almost 300 years of combined experience. They plan to acquire QuantumScape. This is a solid state battery company backed by Volkswagen, Bill Gates, SAIC. They have some pre-orders from Volkswagen, which they will fulfill around 2025. So QuantumScape was able to raise $700 million. So $230 million coming from here. The rest will be coming from PIPE investors. Now, I forgot who had asked me on the Slack channel, hey, have you looked into this QuantumScape company? I'm like, no, I don't know. So now if you're interested in QuantumScape, and if you say, how do I get into QuantumScape? Because I think their solid state battery will revolutionize the whole EV industry. Here is an option for you to get into QuantumScape through KCAC. Or you could wait until the QuantumScape becomes public. Again, it will become public through KCAC, or you can acquire KCAC now. Okay, so I already talked about it, about the PIPE investments. Okay, so of all the SPACs that we have reviewed, KCAC is on my watch list. Let me just skip it. And this is on my watch list. Skills is on my watch list. I don't think I'll be looking into this. Probably not. And this I already got shares. So these two, I'm going to keep it on my watch list to see which one fancy me. Does the solid state is there a market for the solid state? Is it really going to be, great? If that's the case, then I may want to take some positions. So that's all about SPAC. I hope this helps clarifying this whole dark world of SPAC. And right now, frankly, it is the hottest, I would say, venue for companies to come to public, and then suddenly people like us are thinking, I didn't hear about this company before. How come it's suddenly trading at $50? So now we know why it is trading at $50.